Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined by John Blank, Zach's chief equity strategist and a PhD economist, to talk about our favorite end of the year topic. We've done it many, many years now. Will there be a recession in 2023? That's the topic. For all the years we've done it, John, we have not yet had a recession come in. No, wait, I take that back. We must have during the pandemic, but none of us could have predicted that in our end of the year podcast for 2019, that would have been. And it was super quick and we were out of it. But now here we are again. Everybody's predicting the recession for 2023. So what will we say? Will we predict it too? I don't know. And we're going to cover how do you invest for this if we think there is actually going to be one in 2023. So welcome back, John.
Thanks, Tracey.
So I'm doing what I always do when we talk about the recession. You know, I'm paying attention to one of the indicators of the recession, which is the job market. And the job market appears to be freaking out a lot of the recession watchers out there because we're not seeing a lot of weakness yet in the job market. And we still have unemployment at 3.7%. We still have the weekly jobless claims at a, very low level, frankly, for given how much the Fed has been tightening, still under 250,000 pretty consistently every week. Obviously, there's a delay in a lot of the job data. If you were laid off this week, depending on what your job was, you may not file even an unemployment claim for weeks. And you may end up not filing it at all if you manage to leapfrog into another new job quickly. We have over 10 million job openings, so that may happen this time around. So can I look at the job thing like we always talk about, John, or is it just delayed and that area will get darker as we go along into 2023? Or what should we be looking at?
All right, Tracey. So here is the monthly job growth average for 2022. It's plus 392,000.
Okay.
Does that sound like a recession?
No, that's very impressive.
Close, right? That's super hot, right?
No. Yeah.
2021, for example, when we were doing the COVID recovery, was plus 562. So we're down 170,000. We're down about 30-40% in the growth. Now, here's an interesting statement, though. You threw out, the unemployment rate is at 3.7%. We did have 260,000 jobs in November added, but let's just talk about the internals of this. So here's the statement, and I've verbatim quoted. Notable job gains occurred in November in leisure and hospitality, healthcare, and government. Employment declined in retail trade and in transportation and warehousing. So what fundamentally is interesting about that, Tracey? First of all, notable job gains occurred in leisure, hospitality, healthcare, and government. Those are all services, right?
Right.
Employment declined in retail, trade, transportation, and warehousing. Those are all goods.
Yeah.
Right. So the service economy is still humming along right now. And the employment declines that we're trying to get this unemployment rate and the price level down are coming out of the goods market, which is also true for the PMIs. The manufacturing PMIs are below 50 now, and the service PMIs are above 50. So it's totally consistent with what we're learning. So now let's take a look at the survey of professional forecasters, and I'll tell you what they have.
Okay.
So 2023 first quarter, 0.2% GDP. 3.8% on the unemployment rate. So basically just barely ticking up from here, and growth going to 0.2%. Now, if that concerns you, I got to remind you that the first quarter of 2022 was minus 1.6 and the second quarter was minus 0.6, right?
Yeah.
So
we usually
through that, you might blow through this 0.2%. So that, again, That's not recessionary. Like we talked about, jobs is the key thing, and it might tick up 1/10 of a point. Not much. Now,
Right.
2022 second quarter, again, 0.2%, and the job unemployment now starts to rise to 4%, right?
Okay.
Well, what's interesting about all of this then gets into the payrolls that people predict and the core personal consumption expenditure, which is what the Fed will put the Fed funds rate 1% above it. So in the first quarter, payrolls are at 80. And the core PCE is at 3.8, which means they're going to get the Fed funds rate to 4.8. We're at 3.8 now, so we're going to add 100 basis points if the core PCE does what it's supposed to do. By the way, it's at 4.5 now. So the Fed, if it doesn't come down more, they're going to go to 5.5. Then in the second quarter of 2022, it's 36,000 payrolls a month, and the core PCE is 3.2. So here's my problem with all this. These forecasters. When, Tracey, did we begin this super steep rate hiking?
In the spring.
Right. April.
22.
March and April. Right?
Yeah.
When on earth has any economist told you that there's going to be a downturn 7 or 8 months later?
Never.
Never.
At least not. You have never told me that.
I have never told you that. So why on earth? Now, I'm talking about all 45 of the most professional economists in the world. Why do we have a recession with 79,000 jobs in the first quarter and 36,000 in the second quarter for not even a year after we started rate hiking? This, even as an economist, I'm talking as a professional economist, this is way in front running the idea that there's lags and leads on this stuff.
Yeah.
Right? So this is one thing that you and I have been right about all year is by paying attention to the payroll, that 392 number. It was way hot and there was no slowdown for sure this year. And frankly, second half of next year, first half of next year, I'm not betting on a recession at all, unlike these guys.
Right.
And because it, again, just being an economist who's not going to get thrown under the bus here because I work at Zacks, the leads and lags are going to take it in the second half for sure.
Yeah.
So my point is why we're doing this podcast is so critical is the monthly jobs numbers and revised job numbers are all you really need to know. Because these stupid people are trying to jump in and out of boats on, and not get fired in their bureaucratic world. And this is not and they're actually violating their own principle, which is that it takes 12 to 18 months for these interest rates to play out.
Right.
It's fascinating. I mean, I just looked at it and I was like, really? I mean, we're going to do 80,000 jobs in January? I mean, we already got the November number at 263, so we're just going to fall off a cliff after Christmas?
Right. That's what I've been saying, even just to the general random people on Twitter who are going even more outrageous and talking about how the Fed is going to start cutting by early next year. Not just, that we're even going to be in recession, that they're going to cut the rates. And I'm like, but you would need literally it all to collapse.
Right.
And how is that going to happen? We're already in like mid-December.
Right. And I was golfing with some guys, who are in their 70s, early 70s, and they own their houses in California. And we were talking about, the rate hiking and the work it was going to do to the mortgage rate. We all know it went to 7%, right?
Yeah.
But what's the average mortgage rate out there, Tracey, after 10 years of zero rates?
Almost everyone. I think it's only 5% of people with a mortgage are above 5%.
Right. And the average one is 3.5.
Yeah. It's much.
So the point is, the listings, the sales, the amount of people on both sides of the market that can find a deal are going to plummet. But if you look at the number of people in Phoenix, by the way, which is the hottest and worst situation, 0.4 to 0.6% of all people in Phoenix are transacting on a house. 0.4 to 0.6%.
Yeah.
Right? So the point is, it's just not going to happen through the housing market. And then let's talk about the retail sales things. I've just looked at this also for this report on economics I'm going to do this weekend. Lo and behold, there's no sign of any slowdown in any retail category I looked at, period.
No, not even in jewelry. And you'd think if I'm gonna pull back on something, it's gonna be on the jewelry. I don't have to have that. And yet even the jewelry retailers are saying, no, we're fine. Things are looking pretty good still. That's incredible, really.
Yeah, well, what's incredible is the drivenness of the media, social media, and actually cable and business news media, and the incessant drumbeat of trying to get something alarming so people tune in, right?
Yeah. Right.
And people who pessimistically want, they didn't vote for Biden, so they don't want him to succeed because then they can go golf with me and piss on me all day, right?
Right.
For all these people, you say, hey, you know what? What's the payroll number? And they, I'd rather get the recession story done by the first hole so I can play the next 17, right?
Yeah.
And 95% of people don't say what you said, which is it's been 392 all year. There's no way we're going to 70 or 80 in another month. That's sort of obvious, right?
Hey, right.
But see, this is the problem. We've got in bubbles of social media and cable watching, TV watching, and people are also in the professional economist profession just yammering away in their own social media bubble. And we're all walking back the basic concepts we've always believed in, which is the payroll number matters most, and the lags on rate hiking by the Fed are at least 12 to 18 months, right?
Yeah.
All you can do is say one or the other has to really, I got to honor both, which means if it really comes in fast, the payroll numbers will roll in and we'll pick it up. We don't have to think about the projections. Those are just not really happening. We'll just catch it month to month, like what we said. Just try to be in the moment and change your views in the moment, and don't miss out on all the madness, because the stock market will walk around up and down. That's going to happen. But it does not mean the economy's walking up and down. There's the rate thing. Let's see how it plays out here. Nobody's ever rate hiked this fast, this quickly, and it still remains to be seen if it really matters when you put that in front of 10 years of zero rates.
Right. Yeah. And I do think on the housing side, there's still a lot of post-traumatic stress syndrome from, Gen Xers and baby boomers about what happened in 2008 to 2012. And that's why everybody's still looking at housing again as the place where that could cause it. That could cause the recession, because they're still thinking, oh, this is like it was before, when it's not anywhere close. And we've been 15 years later after that housing bust. And what people forget is, baby boomers who owned their house in 2008, certainly, if they stayed in it, they certainly own it now in 2022, 2023, and it's most likely paid off now. So the scenario is a little bit changed, 15 years later. About 40% of homeowners own their houses outright now, which is a lot of money sitting there, a lot of equity, a lot of firepower that maybe was not there to that extent in the prior type of cycles too. So I don't know. I just think people are looking at all the wrong things as to why the doom is coming and, what's going to cause it all other than the Fed tightening. They're looking for some other outside area, and I don't know, maybe it's the Bitcoin and all the stuff that's going on with FTX. Maybe that's the catalyst this time. I don't know. But I don't know, what's the percentage of people who were invested or are invested in cryptos? I don't know. Do you know?
Yeah, FTX is, we can answer that ourselves. The FTX did $30 or $40 billion in losses if they're catastrophic.
Well, yeah, for them. Yeah. But if you were like outside of FTX, there's some people who weren't in there. So
so you go from 25,000 to 70,000, then you lost 30, 40, 50%. But how many people did that?
I don't know. Right. Not that many to cause contagion, but I don't know. It is definitely going to be interesting. But on the stock market side, we know that the market will try to price in any kind of recession ahead of time. So what do you do as a stock investor then as we head into 2023? We've had the big sell-off here in 2022, but we've had a nice rally at the end of the year, so it's not as bad as it was a couple months ago. And, do I go into what was working for this year? Do I stay in, for instance, like an Exxon? It's up 69% year to date still, but you do get that big dividend. Shares are still cheap. Do I go into the banks as the Fed continues to tighten? I thought that would work last year. I know you've liked some of the big banks. We've talked about it. I own Bank of America in my value investor portfolio. I think you own JP Morgan again, right? You're back in there. Yeah. JP Morgan down about 17% year to date. So, kind of near what the S&P 500 has done now. But you get that dividend and that's cheap. Retail, I do like the retail story, but I am a little leery, even though it's holding up, as we just discussed. I am a little leery about diving in there ahead of a possible slowing of the consumer. So like ULTA, a lot of people talking about that one. On the beauty side, it just had a pretty solid quarter and is looking at a solid holiday season. It was a little cautious, but that's understandable. But they're seeing pretty good numbers there. But that's trading at 21 times, so not real cheap. I don't know. I know a lot of people are hiding out in the big drug companies. A lot of people talking about Eli Lilly right now because year to date it's up 32%, breaking out to new highs. But I took a look at it because I haven't looked at it in a while. PE is at 47 now on it, even though those estimates are being cut a bit here. So it makes it more expensive. And the dividend, not that great, 1% for Eli. But took a look at Pfizer. That's cheaper, PE of just 7.9, but earnings really expected to be cut for next year, down 25%. Analysts not liking it. Those shares are down 16.5% year to date now for Pfizer. So I don't know, John, what are you thinking about for 2023 in terms of, just investing? Should we stick with what's worked, like the Exxons, or, now things are on sale, we can get in there? Do I try to get a dividend payer? What do I do?
Well, I would throw out three ideas here. One is the Qs.
Okay.
The NASDAQ 100 tracker.
Yeah.
It sold off the most, so they'll come back the earliest. The other is semiconductor ETF XSD, which is the most equal weight of the semiconductor indexes done by the Spider State Street Group, which I've learned has done more of the heavy lifting and getting your passive investing right for you and is reasonably cheap from an expense ratio perspective. Okay. The third one I would throw out is a blend of the mid caps, any of the ETFs in mid cap blends, which are not the small caps, which will be more volatile, but stocks that you don't know about, but just buy the blend. Don't buy the value or the growth, and just buy the super low ratios, and then stay regular with those ideas. Don't try to time in on it. And if you allocated to those three ideas, once a quarter or every 2 months, you're probably going to put in some nice valuations on those stocks, and you'll come out the back end of this whenever this ends, which, by the way, nobody knows. And by the way, the market will, again, just like everything else, will be leading it 12 to 18 months. So it'll turn around whenever, that big wheel turns out there in the world. And you're not going to time the bottom, but you're going to be able to be in buying, around both sides of the bottom and at the bottom if you keep on with something like that.
Okay, that's good advice. Yeah, I feel like
I can give you. I think people, turn to people like me or you, like we're going to be some geniuses and figure this out. And that's just what we're going to do. Is we're going to work, and we're going to go and like we do podcasts, we're going to do them regularly, and we're going to talk about the payroll data and tie our hands to it.
Right.
That's the job here, everybody. Our job is to do these podcasts and tell you what the payroll numbers in, and hold our language to not becoming perma bears or perma bulls. Right.
Right. Yeah.
It's about what happened. We got a perma bear situation going on in the economy right now. Right. It's not clear it's going to happen. We have a perma bear situation.
We do. A couple other interesting things just about a recession next year. What what are the odds that it actually gets pushed back to 2024? Like there is a small contingent. Yeah, there is a small contingent saying that they believe it won't actually start until, first half of 2024.
Yeah, I'm kind of with that. I think the basic problem here is you've had 12 years of asset, baby boom think, which is, raise the value of my house and make me a lot of money in it, raise the value of my stocks, make a value of money in it, let me retire to Florida and sit around and piss and moan about it.
Right.
And of course, what happens is there's the generation below has to go to work and pay for overvalued houses and buy into overvalued stocks. And it turns out there's not as many of them because the baby boom is what it was, a boom. And so there's this transition that COVID's presenting to people, which is actually pro-work, pro-wage, pro-generation.
Yeah.
And it may surprise people that there's a structural flip of the switch here that COVID actually presents itself.
Okay.
And it is not, quote, cyclical, right?
It's right.
Change. It happened in a kind of discontinuous way because of the nature of how COVID, shut us all down for 2 years.
Yeah.
So I think this is what's missing here is people not understanding structural change that's been building got accelerated, and we're just kind of probably watch that play out.
Yeah. Okay. Well, yeah, I definitely think things are going to be different than what everybody is assuming, especially on things like, even just basics like mortgage rates. Everybody assumes, they're going to be high, and then the Fed will cut and they'll go down again, and we'll be back to like 3%. Well, in the 1970s and 80s, that's not what happened. Even as the Fed did start easing, the mortgage rates remained elevated for over a decade. So why does everyone assume this time it's just going to drop back down and, we're back to the party again of, rising asset prices and everything else again? I don't know. I just feel like this time maybe it is different than what we've seen over the last, 10 to 20 years or more now. And there's going to be a lot of adjustments by everybody in all asset classes, I think.
No, I think that's fair. I mean, I think, when I do returns assumptions, I looked at 8% as your return on average on most of these indexes, which is the average return going back over the last number of decades, not the average return over the last 5 or 10 years. And again, that's the other thing that's going to probably happen here when rates stick around longer like they're going to. I think you're right. And that's going to be a, quote, normal period that we forgot about.
Right.
Normal, we're earning 8% on your ETFs that I threw out there, right?
Right. Or actually putting
money. Not going to work for me. It's like, well, that's how it usually did,
Right. Or people may actually want to put money into their savings account at the bank. Right. Because they may get 5% on a savings account suddenly. And that's, totally different. Nobody even has a savings account anymore. So, yeah.
Right. That's it. This is what people got to realize. COVID may have presented a speed up of a generational shift where there really is a difference of opinion on everything. And, unless you're going to do what we're trying to tell people to do it, and the only reason we're to keep insisting upon it is because so people want to do it, which is just pay attention to payrolls, right?
Yeah.
Don't sit around and talk to your friends. Don't get into your political bubble, whatever it is. Don't get in your generational bubble. Just try to pay attention to payrolls because it's netting out the entirety of all these headwinds and tailwinds for you. Because what people don't understand is, there's always tailwinds and headwinds, like always.
Yeah, right. For sure.
The housing market's going down. Well, how big? How much? Well, you don't know. Right. So if payroll numbers don't roll over, it basically isn't that big a deal. That's basically the answer.
Yeah.
Okay. Yeah, Morgan Stanley, or Wells Fargo fired out the mortgage board. Yes, they did. It's still not rallying the unemployment rate of the payrolls.
Right.
Oh, I heard everybody's firing at Meta and Amazon. Everything's falling apart. Yeah, right. And the payroll number was 263 in November.
Right. I do think we're a little bit too focused on technology and those big companies and the jobs that are there. And, the U.S. economy is much larger than just, these 10 big tech companies, or even just tech in general, even though it's a large sector for sure. But we know that there was overhiring at some of those places. And so the ship has to be righted somewhat. But that doesn't mean there was overhiring at, John Deere or Baker Hughes or any of these other places. So
Cummins, which is still in the midst of a huge undersupply of automotive players, and that manufacturing growth of automotive can carry us for a good 2 years.
Right. Yeah.
You have the China story where they finally, get out of COVID. If they have an Omicron wave, they finally get their herd immunity over there and they get out of this.
Yeah.
So this is the problem. I mean, I was just thinking about I did a show yesterday about, Tesla and Elon Musk. You would think that Tesla and Elon Musk are the only cars being bought right now.
Right.
And, the other day I did a show on Stellantis, which is, got 15 brands of Fiat, Jeep, Chrysler, all those names.
Yeah.
How strange a world we live in and how skewed your perspective is. By 2025, which is, by the way, only 3 years away, they will have completely revamped all 14 brands to 100% electric in Europe and 50% electric in the United States. And they will have revamped 55 actual car things and all 4 chassis, from trucks to middle to light to small. Right?
Wow.
I'm putting that out there because you didn't hear that, because you heard nonstop 24/7 about Tesla and Twitter and Musk.
Yeah, for sure.
So what has happened is that, some of these, people are figuring out, hey, I can get on Facebook and own it and just, blast the airwaves. I can own Twitter and put out, 5 bazillion tweets and convince you how a lot of things are happening.
Right.
And you're like, Elon Musk must be running the world. No, he's not. He's just sitting around tweeting in San Francisco a lot.
Right. For sure. Well, that's where, good stock investors look for opportunities in what you just said. Outside of Tesla, there are going to be opportunities in the electric vehicle space, right? On alternative energy, all of this stuff. And there are going to be some good stocks that people are going to want to be in other than Tesla.
Yeah. Buying Stellantis at $15 a share.
Yeah.
I mean, call me dumb. Call me the dumbest guy ever. I'll probably make money on it.
Right. Okay. So I guess that's concluding our discussion for this year's version. So we didn't really conclude if there is going to be a recession in 2023, but there may be, but not in the first half, I guess is what we concluded. That it would probably come in the second half if it comes, and we have to watch the payrolls, and it's all about the jobs.
That's it.
Yeah. Okay. So that makes sense. And we will regroup next year to discuss this again, as we always do. We do this show more than once a year. So we will be regrouping. You want to be sure to subscribe to get, all of the episodes. You can get us on Apple Podcasts and on Spotify. But let me give you the tickers of what we talked about today, because it's kind of extensive this week. So I did mention Eli Lilly. It's busting out to new highs, ticker LLY. Then there was Pfizer, ticker PFE. We talked briefly about Exxon, ticker XOM, JP Morgan Chase on the banking side, JPM, and we mentioned ULTA, ticker ULTA. I own ULTA in my own personal portfolio, as many of you know. Then John talked about, just keeping it basics with some ETFs. He likes the triple Qs for 2023. QQQ is the ticker there. Then the semiconductor equal weight index is X as in X-ray, S as in Sam, D as in David. Then he mentioned just buying a blended, just regular mid cap. And if you want to keep your expenses down, you might consider the Vanguard mid cap ETF. It's just the basic one, ticker V as in Victor O, just the two letters VO, has an expense ratio of just 0.17% for the Vanguard. But that's about it. And as I said, you want to make sure you are getting us. So get us on Apple Podcasts, Spotify, Amazon Music, and we'll have one more episode before we get into 2023. Don't want to miss that one. And as always, I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.